When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name's Jeff Shea, and as always, I'm just here to ask the questions. But the words of wisdom and solid advice, they come from the other Jeff. That would be Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and also up in Mesa. Hey, Jeff, how you doing this fine weekend?
It's always great to be with you, the listeners here, and just talk about stuff. You know, it's kind of my therapy session. Get a lot of things off my chest from the prior week.
I know. Well, I'm going to give you a chance to pontificate today. I'm glad you're doing well. Hope our listeners are having a great weekend. It is the first weekend of October. Frost is on the pumpkin. Everything is pumpkin spice here. And just about 30 days away from the presidential election, so things are beginning to heat up a lot more. Speaking of that, I was looking at a clip the other night on my computer of Ronald Reagan. Back in 1980, he was running against Jimmy Carter at the time, and he asked America, are you better off now than you were 4 years ago? It was very interesting to see President Reagan back in those days. He had really the ability to communicate with a camera and in turn could really communicate with the people. But that was a powerful question. Are you better off than you were 4 years ago? He went down a number of different categories and he said, listen, if you're better off than you were 4 years ago, then you should vote for the incumbent candidate. He didn't mention Jimmy Carter by name. So I'm going to ask you, Jeff, do you think we are better off now than we were 4 years ago?
Well, it's all relative, specifically to the different people in different categories of socioeconomics and that kind of thing. I mean, people in the lower income ranges, you might say, have benefited greatly because, their wages have gone up, but the higher end hasn't necessarily, or vice versa. There's a lot of high end people that have, jumped big time. So you have this overall increase in, worker rate wages, but you have an overall increase in inflation of things, 21% over the last 4 years. Things have definitely changed. Are people better? I think some people are. If you've had a lot of money in the stock market and you've allowed it to ride and, the constant manipulation of the market by market makers and the Fed and politicians that aren't really letting fundamentals drive the markets, which honestly haven't really been the case for a while. I have a problem with looking at fundamentals, and absent of fundamentals, I have a really hard time buying into a really high risk overpriced market. But nevertheless, some people that can afford to lose money are still in the growth phase or doing a little bit better. If you've owned real estate, you've done really well. But if you're just a worker bee trying to make ends meet for your family, there's a lot of people I know, including my children who are raising families, who are having a lot bigger struggle, making ends meet, making sure that they can pay for the things that you used to pay for a little easier a few years ago, in today's economic environment. So, for many people, it is better. For many people, it's worse. I don't think the environment of inflation that we had during most of the last 4 years is a healthy at all. And it certainly isn't. And it was just exacerbated by constant money printing, basically QE, quantitative easing, which they're kind of faking right now by lowering interest rates on short-term bonds, making it look like, the long-term interest rates are down. Well, long-term interest rates aren't down. They're still up where they were a year ago, pretty much. They're down a little bit. But bottom line is, we're not really seeing a turnaround in the economic fundamentals from the standpoint of the economy, other than the fact that, since inflation already went up over 20%, 25%, if you look at true inflation, I think those numbers are closer to 25 or 30. And that's not just based on the CPI numbers that the government shoots out. It's a little worse than that. Some people are struggling. The people that have to drive a lot are spending a lot more money on gas. If they have to use more gas than the average person, the person that has 4 or 5 kids instead of 1 or 2 kids is probably struggling because the price of diapers has doubled and the price of food has, gone up a third to a half. And in some cases, the fruits and vegetables that I buy, I think have more than doubled in the last 4 years. So, there's a lot of different scenarios. I guess the answer, as usual, is it depends. If people are better off now than they were 4 years ago. I think the fact that, the job market is getting a little bit tougher. We've seen the unemployment rate grow a little bit lately. We've seen job openings become kind of at the lowest levels they've been in about 10 years, other than, for a minute there during COVID. But we've seen, some tightening of the labor markets. We've seen a lot of inflationary pressures and things that historically end in a recession still staring us in the face. So are we better? Well, I think we're looking at an economic backdrop that is a little bit sketchy. I think we're looking at a stock market that's incredibly risky. Does that mean we're better or worse off? Well, it just depends. If you had all your money in the stock market and got scared out of it and then just bought in today, that's probably a bad idea because you sold low and bought high. If you only had a little bit of money in the market, lost a little bit, but you still had the rest of your money in safe stuff that continues to go up on a nice incremental basis that is keeping up with the inflation. If over the last 4 years, inflation's up 20 or 25, as long as you made 5 or 6, you're still ahead of the deal. And you didn't have to take a lot of risk to do that. Some people have had a real roller coaster ride and a lot of gut aches just dealing with markets and investments. Some people have had a real struggle when they go to the store and find out the end of the month is further out than the end of the money. That's not a good thing for many consumers. So, I guess your answer is kind of a long one, and it depends. I don't know with the border open, crime going up, prosecuting less crime, I think the world's not quite as safe a place as it used to be. I think foreign leaders were a little more afraid of Trump than they are of Biden and Harris. And that's why all the foreign countries are endorsing Harris. They know they can get away with whatever it is that they get away with. And I think that creates a lot of danger and a lot of frustration for the country. So whether it's monetary and you're doing better or worse or not, I think there's still some other issues that need to be considered as far as are we better or are we worse off based on this last administration that's been in power, not really done anything to make life better for consumers. It's in many cases gotten worse. There's been a lot of pressure for companies just based on this inflation situation to have to raise wages. We've seen that come through in the lack of earnings for public companies and stocks that, the stock market trades. And basically the price of a stock is determined based on earnings and growth of companies. And there's not very many that are growing. Last year, we had an increase in earnings of about 1% overall in the S&P 500. That's not healthy. We've lost manufacturing jobs to foreign countries because things cost too much to make here, and we've allowed China to get a big piece of that economic portion of our economy. We've kind of been asleep at the wheel in a lot of things that I think would keep us in a more solid foundation moving forward. So I think there's some corrections that need to happen. I'm not necessarily talking about the stock market, but corrections in the standpoint of policies, focus on America first. I don't mind being part of a global economy, but I don't believe in, making sure the rest of the world is more safe and better off than we are. I think, Trump has that focus in mind. And, 4 years ago, in the prior 4 years, we saw a lot of things that got better in America, even during the COVID crisis. We were energy independent. We got a vaccine fairly quickly. We, were lied to by the health department quite a bit. And, the powers that be, I think, misled us and the president and some of the people that were trying to make good decisions. But we got through it. We've emerged victorious once again as strong Americans and an economy that rebounds from things. But we really haven't seen the GDP, the gross domestic product growth, come back to prior levels before all this happened. It's growing at 2 or 3%. Well, it's just barely keeping up with inflation. And if you read many of the numbers that they're spouting out now, they're non-inflation adjusted numbers. And if they're not adjusting for inflation, then we're getting a misreading of what the economy is really doing. And honestly, the economy's been flat, even though the stock market's gone up. So the stock market continues to become more and more risky and more overpriced. One of those things where, man, you hate to miss out. You want to get in there and be swinging for the fences with everybody else that's making money. But then again, can you risk it? And I think the economic backdrop means we're going into a place where, we have to think differently. We have to be differently. So does that make you better off? I don't know. It just depends. Everybody's got a different story. I know some people that are, struggling because they couldn't afford to lose money and lost it in the market. I know some people that were forced into retirement a little bit early and didn't have that extra 2 or 3 years of income to pad their retirement plan. I know of people that had some emergencies happen with their children that they decided to help them, and it affected their own retirement financial stability. So I see it from different angles. I see other clients that have been aggressive in the market because they're worth millions and they have millions to lose and they don't mind taking risk, that have taken advantage of some of this upside in the market. But again, it kind of depends where you are and what you've been doing, whether you're better or worse off. I can't say, I'm worse. I'm better off just because my business keeps growing. That doesn't mean the economy's doing great. It doesn't mean everybody else is doing great, but it's kind of hit and miss. That's the thing. America's kind of a mixed bag of different experiences, different, positions economically. While I think some people have made it better, there's enough that's gotten worse that we might want to rethink who's in charge of our country and who's in charge of our economic plan, who's in charge of the policies that dictate our future. And I think if we look real closely, we'll realize that things are probably going in the wrong direction, at least in my view. Of course, my radio show is about my views, and
right.
I'll tell you what everybody else thinks, but my views don't have to be your views. But I think I'm in line with most of the listeners, at least the feedback we get. We're all a little bit concerned about the direction that our country's taken, and we're a little bit worried about our kids and our grandkids and the future that they have. unless we kind of right the ship and make more sound fiscal decisions and policies that make America great and make America strong and keep America safe and keep our foreign adversaries out of our hair and keep all the foreign illegals in the cells that some of these terrorist countries are sending over through our open borders to possibly, set up an inside attack. We got to get rid of all that stuff. Those threats are real. And I think people are real complacent because it hasn't happened or serious things haven't happened for a while. And we think, oh, well, it's not going to happen. We're America. Nothing bad happens here. Well, that's not true. We had 9/11. And I think, if we don't watch our backs, we're going to be in that same position again. So I think more than just an economic backdrop, we've got to think about our country's safety and our country's security. And as the election nears, I think we need to reflect and dig deep as far as, who we vote for and why we vote for that person or those people.
Yeah, and we're going to be able to make our choice here in just about 30 days to answer that question. Are we better off today than we were 4 years ago? So let me ask you this. Depending upon which candidate is successful for the president of the United States, do you have a different strategy or a different investment plan or a different way to handle people's money that's waiting in the wings?
No, I don't think I have anything waiting in the wings. We're already preparing for whatever. I mean, I think tax planning is going to be ever more important in the future, especially if Harris gets elected. And I think, the markets and the government and all the, the unelected bureaucratic departments that are in position to put her there. She was the dog of the politics 3 months ago. And then all of a sudden now she's the darling of the world and going to save everything. And, I don't get how they can push that on the American people and actually get away with it. But, the news is behind them and everything on TV is true, right? If you watch it on TV, it must be true. So whatever they say is, Harris is the savior of the world. But I think she's going to tax the crap out of everybody who's got money and try to redistribute it. I mean, talk about socialism. I mean, she's beyond socialism. It's going to be wealth redistribution like I don't think anybody's seen before. And you're going to have to find ways to protect your wealth. But we've already done that. We've always been kind of a wealth protection strategist. We've always talked about taxes. We've always talked about minimizing taxes, keeping yourself in the lowest tax bracket possible, and doing some planning to get you out of those future tax hikes. If you can look poor in retirement, even though you're rich and have sheltered assets in tax efficient programs and you've lined up your money to where you use it efficiently, tax efficiently, then those tax hikes won't hurt you as bad. So I think that's probably the biggest thing that I see coming. I think no matter who wins, there's going to be a recession. They say there's going to engineer a soft landing, which is very unlikely. Historically, it hasn't happened, but everybody's, believing it. But every time we've heard the word soft landing or believe the words no recession, there's always been one. Given the circumstances similar to what we're seeing today. So, I'm not going to discount history. I'm going to hope for the best, but I'm going to plan for the worst. I'm going to hope that, Trump can get back in. I think he did a better job. He's a businessman. He understands how to get our country to be more likely to reduce the debt than increase it, more likely to do less fiscal damage to our future, to our children, to our grandchildren than the Harris type of an administration and the administration that we've had the last 4 years. They're just into money printing and taking and redistributing wealth. I think, though, the super rich are going to get richer because they can continue to print money, which will make the market go up. So, those people that are, willing to take risks may actually benefit. Inflation typically increases things for rich people, not for poor people. It creates a situation where then they have to play Robin Hood and take from the rich and give to the poor. And the more people they can make feel poor, the more the government can reach out and help them and become, kind of their servants. The poor class gets bigger and bigger and has to become so dependent on them that then they never have to worry about an election again because everybody will have to vote for their, bread and butter and their livelihood while, the rich get certain tax breaks. I don't think they're going to take all the tax breaks from the wealthy. I think the middle class are the ones that are going to suffer the most, even though they say they're going to take them from the rich. They're not. Those are the guys that pay for their campaigns. Those are the guys that put them in position. They talk a big talk, but they never do anything to, reduce those tax programs. Well, why can't a middle class person use the same type of tax planning that some of the rich people use? Well, they can. They just don't get told about it because their banks and their brokerage firms always say, oh, we don't give tax advice. Go see your CPA. Well, the CPA that you use probably just does tax returns and knows really good tax code, but doesn't really do a lot of planning and doesn't know a lot about the investment instruments that are out there by and large. Now, there's some CPAs that are extremely good at tax planning, and those are people that are probably well enough taken care of that I don't even see them, but because they're getting that help. But for the typical person that's out there just trying to make ends meet and try to retire with a peace of mind and a sound financial plan, they don't get that advice or those directions from the typical, tax preparer or from their brokers or their banks or any of their investment advisors. That's why we like to be different. We like to add that as a big piece of our planning. We want to protect assets. We can use trust in some ways, whether it's revocable trust to get you out of probate, cause a little bit of a tax break for succession planning. We have, some irrevocable trust that will protect assets from certain things. We use insurance products that are off the grid, basically stealth money that you can use, kind of like having your own tax-free bank where you move money from one account to a different account that's more of a stealth account that doesn't get reported, doesn't get 1099s. And that's what the super rich use. And they take advantage of these tax advantaged products, investment strategies. And we try to do the same to the extent that we can for the typical person that's worth a few $100,000 or a few million, not the hundreds of millions and the billionaires. We want to help the people that have saved a lot, that have worked really hard, have enough to retire as long as they don't lose it, and as long as they don't get taxed to death out of it, so that everybody who didn't work and save as good as them, get benefited by their hard work and savings.
You're listening to Premier Retirement with Jeff Ogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. And if you'd like to come in and sit down with Jeff, talk about your individual situation, we are offering this Premier Retirement and Wealth Management Roadmap. You can take advantage of the opportunity, no cost, no obligation for that, by calling 520-780-9059, 520-780-9059. Make that call this weekend. Phone lines are open right now. Leave your name, telephone number. You'll get a call back during the week from Shelley, who will set up that appointment for you. Again, no cost, no obligation. It's just a casual conversation to talk with Jeff about your financial future and answer the questions that you need the answers to. Again, 520-780-9059. You can find out more about us online at premret.com, premret.com. Jeff, just a moment ago, you mentioned China, and I know that David Tepper, a billionaire, says to invest in everything Chinese. Let's talk about that a little bit, your opinion on investing in China and basically international investing in general.
Well, I think the international market is looking a little better. Either they're manipulating the numbers. Other countries, including China, just recently gave a huge stimulus package. I ended up day trading a few Chinese stocks and, did pretty well for a few days. But the thing is when they gap up and go, when you have stocks going up 15 and 20% in a week, are they going to continue to climb like that? Probably not. The Chinese economy has been pretty bleak for a long time, and I don't think the economy's even, getting stimulated. They're just throwing money at the market, just kind of like we've been doing. So, if you've got money to throw in the market, maybe you can take advantage of these, liquidity issues when other countries like China are increasing their liquidity by doing QE programs like we did forever. But, it's just going to cause issues with inflation to them. It's going to hurt China more than it's going to hurt us. I mean, if we're buying a widget for $2 from China and selling it over here for $50, I mean, that's a pretty good deal. But, in China, if they're used to paying $4 for that widget because their average income is $10 a day instead of hundreds of dollars a day like it is here, when the widget doubles, we have to buy it for $4 and we still sell it for $50 and still make a mint. In China, they're using half their income to buy the widget that they used to buy. And you can use widget for anything, but I think the Chinese government and other governments around the world are trying to emerge out of this, bad economy that they've actually admitted to having. We've had a bad economy too. What's happened is, as far as buying everything Chinese and investing in China, a lot of our manufacturing, I mentioned this several times, is manufacturing has been decreasing in America. We've been losing manufacturing to a lot of places, like John Deere wants to move to Mexico, Donald Trump, and I think they're going to wait till after the election because Donald Trump says if he gets elected, he's going to put 200% tariffs on everything they send back from Mexico. So he's going to say, no, you got to stay here and produce here because it helps the American economy. If you want to go out of the country, then, sell your John Deere tractors for more. And then, you'll have Caterpillar and other local based companies that are still building stuff here, get the business. So, there are some economic policies that would, create more, benefit to the American economy. But if you buy Chinese stocks, that means people are going to have to continue to buy more and more stuff overseas in order to get their economy rolling again. And I think it's great if they can get their economy rolling again. I know their economy has pretty much been a manipulation for the last 20 or 30 years. They manipulate our currency. They manipulate their currency. They play a lot of games that most companies don't get away with. But, right now their stock market's been beat up. It's looking a bit better. I don't know that it's because earnings are growing, but I know that our country has sent a lot more manufacturing over there as we've been decreasing manufacturing here in order to fight inflation. It's a cheaper place to produce things. Again, if there's tariffs on China, it might help bring investments back to America. And in that case, don't invest everything China, invest everything American. So it might be, smart to wait till after the election before you decide if it's China or America. Or, maybe for now, for the next couple of weeks, maybe we dabble in some Chinese stuff and, hope their market continues to react to their recent stimulus. But I think it's overreacted. And I think every time the market bounces 15 or 20%, in a short period of time, you've got to worry about that big gap up being filled in with a lot of profit takers and sellers and, having to go back down again. So, I think if you're a long-term investor, I think I'd still be very skittish on looking at China long-term. I think, their economy is going to be manipulated and probably going to be grow. But again, their market has not been doing that great compared to our own for quite a long time. So if you're just looking to make money in the market, the U.S. market seemed to be a little stronger. And it's manipulated too, I think, in a lot of ways by just the BS that they're telling us and the fact that we've already priced in like 7 or 8 rate cuts and we only got one so far, a 50% rate cut, which usually only happens on an emergency basis, save the economy. So, I think Powell knows that the economy's on the verge of something bad and needs to, shore it up a little bit in addition to the election pressures. We had the Senate Banking Committee, Elizabeth Warren and a couple others that sent a letter to Jerome Powell, sent a letter that said, hey, we respectfully request that you lower interest rates even more, like 75%. They want to create such a short-term rally because they know there's such an excitement level with rate cuts that actually happen. I mean, shoot, there's a big enough excitement level with the rate cuts that don't happen. You get rate cuts that do happen, and the market goes on a feeding frenzy. It did for a couple of weeks look like it's kind of softening up a little bit this week, and we've got some issues overseas that we might have to think about. We've got some, economic issues that aren't really as good as they seem like. For example, the labor market went up this week. And as far as job openings went up, oh my gosh, they're so excited. Job openings. Well, a lot of that's because, summertime's over and people are kind of getting back to work and maybe doing some rehiring. But they're not huge. I mean, the numbers aren't so big that it's like, oh my gosh, the economy's better. But they're better enough to where Jerome Powell might not have as much reason to lower interest rates if in fact the economy is still holding its head above water. I think there's a lot of things that are pulling in both directions. And I think I would hate to be the Fed chairman right now with all the pressure you've got from the political regime in power. And then you've got the real job of actually trying to manage the economy with the interest rates and keep them at a place where the economy can function and grow, yet not, kill the middle class or, kill people's ability to survive in America or to grow and to thrive. He's got a really hard job. I don't know if he's going to get through it. I don't think we escape some sort of a recession. It usually when they say soft landing, it becomes a hard landing. There's only been one soft landing in history. I don't think the no landing scenario that the economy just keeps going can do so without some sort of a market glitch. But back to buying everything in China. The only reason you want to buy in China right now is because of the stimulus and the lowering interest rates and basically the injection of capital. The same reason would be in America is not because the economy is really flying high, even though the jobs numbers were maybe a little higher, but only because, Fed's going to continue to drop interest rates and hopefully not be suckers and just buy into that letter that asks for a bigger rate cut. They promised more rate cuts through the end of the year, but guess what? The election could happen. They could say, oh, we don't need rate cuts now, sorry. But the market goes and creates new highs right up to the election. And they think, look at, the Harris policies look good for the market. Isn't that great that we can vote her in now and make her the president because all this has happened because of the anticipation of getting her in charge and having, easy fiscal policy so that we can print money and create all kinds of liquidity for the markets. All the while we hurt the middle class person. We hurt America in general. I don't know if that was a roundabout question of why invest in China versus invest in America. But I think at any case, you need to be very cautious if you're investing at levels where there aren't really earnings growth supporting stock market growth at the levels that we're seeing, other than just seeing liquidity. I mean, just because there's liquidity injected, does that mean the stock market's going to always remain high? I don't know. There's going to become a time when rich people and just smart investors want to take some profits. Or if the economy gets a little bit skittish, that people are going to have to tap into their 401ks or even take loans to, make ends meet if they don't get raises or if they lose a job or have to downsize or, something happens in, what typically happens during a recessionary time. And a recession is just a reset period. Well, the world is never going to be free of recessions. They happen. It's cyclical. They always happen. It's not like, oh my gosh, I'm going to retire and America's in such great shape. Let's make sure that we're not on the wrong end of things, when we're staring the face of all the things that would say in a recession. Now, China's in that same place. Do you really want to invest in China? I don't know. I think he's a little bit nuts, but he's got billions of dollars. He's a billionaire and he can afford to lose half of his money and still be just fine. He'd still be very, very rich. Most of the people listening to this radio show, I'm guessing, might have a few million, but not a few billion. But bottom line is you probably can't afford to lose half of your assets by betting wrong, just because a government prints money and may not print money forever. Or we can just say, you know what, they've learned to print money and that's just definitely going to be the norm. We can invest anywhere because we know they're never going to let the market crash. That might be the new reality. I can't see it, but I might be a little bit naive to think that could be the whole new reality. It's been pretty close to the reality since Obama took office. But the fact is the market always seems to go back and do what it's supposed to do. We just never know when it's going to do it.
Let me talk to listeners here for just a moment. Imagine the future if you feel that you're on the path to a great retirement. I don't want you to do anything right now, but if you're not sure what your plan's going to be, if you'd like some help to ask the right questions, get the answers that you need to put you on a path towards a prosperous retirement, then listen up because this is for you. It's called the Premier Retirement Roadmap. No cost, no obligation for that, and you can get it right now by calling 520-780-9059. 520-780-9059. I know it's the weekend, but call right now. Leave your name, telephone number. Shelley will call you back during the week and set up an appointment for you to come in, sit down with Jeff, and have that casual conversation. Again, no cost for this, no obligation whatsoever. 520-780-9059. You can also find out more about us online at premret.com. That's PREMRET.com. Jeff, time for a break. When we come back, we've got listener questions and more when Premier Retirement continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shade.
We so much appreciate you making this part of your weekend. Of course, this is Premier Retirement with Jeff Hogan. My name is Jeff Shade, and if you're just joining us, we've had a great conversation this morning asking the question, are you better off today than you were 4 years ago? If you'd like to hear that part of our program, you've missed it today. Remember, we're also a podcast. Go to wherever you get your podcasts, search for Premier Retirement with Jeff Hogan. You'll find this show, many of our past shows, so you can stay on top of your journey towards a prosperous retirement. Once again, our telephone number, 520-780-9059. If you'd like to get in and sit down with Jeff, it's called the Retirement Roadmap. No cost, no obligation for that. Once again, 520-780-9059. Each week we get questions here in the radio program. We try to pick 3 to answer for you. And the first one this week is Daryl listening to us in Tucson. Daryl writes, "Hey Jeff, I'm 62, plan to retire at 67. I'll have $3,000 a month in Social Security and a $1,500 a month pension. I'll still owe about $100,000 on my house. I'm also widowed. Being that I'm 5 years away from retirement, what should I be doing now to prepare myself generally?"
Well, I think, if you've worked at a job, that pays into Social Security and gives you a pension, I don't know if what your income is, but you didn't list a 401k or IRA or other savings accounts here. So maybe you're just paying into a deferred comp plan or something that turns into a pension. I would say the next 5 years, if you're widowed and you can live, if your budget of your spending plan is less than what you're making, then, you start a nice little savings program. If you have a 2% mortgage, I don't think you should pay off a 2% or a 3% mortgage if you can make 5% by just averaging into a short-term bond or interest-bearing account. You might also, try to have some, value dividend-paying stocks or some interest-bearing accounts that you could dollar cost average into with $1,000 a month or something like that to just kind of pad what I would say that you don't have here, at least to mention, is some sort of a nest egg for the chunk monies that you need when you need a car or you need, fix a leak, go on a trip, see a kid, whatever. If your spending plan says you can live comfortably on $4,500 a month, minus the taxes on that, which, won't be much. Social Security's going to be, you're going to be taxed probably between 50 and 85% of the Social Security is going to be taxed. I mean, you'll have some taxes to pay, but, it depends on what your budget is and what your other savings is. I don't know how much you're making now, but I would say try to get some sort of a little nest egg emergency fund put away for those what-if expenses that happen, because you're going to be on a fixed income. You might not have that little nest egg account that you can draw from when, those surprise things happen.
I guess another question that you might want to ask yourself, too, is how long do you plan to be retired? And healthcare expenses, as you said, that's another big one. If I'm 5 years away from retirement, I lose my employer-sponsored health care. How do I plan for something like that?
Well, if he's retiring at 67, he'll be on Medicare on this particular question. So, I mean, that's going to be okay. But you'd want to budget in probably a supplement. I don't really care much for Advantage plans personally, but some of the listeners probably hate me for saying that, but I really don't. I'm a supplement guy. But your health care, if you've got it covered with your job, and if you've got a pension, there's a good chance you've got a government job, and they've got pretty good health care until that transition takes place.
What about long-term care, though? How does he budget for something like that?
Yeah, well, that's why you need that little extra nest egg. If you can save for 5 years and put $1,000, let's say you put $1,000 a month away, there's $60,000, and if you double that a couple of times, you've got a few $100,000 in the bank to cover those costs. You've also got equity in a house that most single people can also draw on. either through a reverse mortgage and use those funds to pay for health care in the home, or you downsize, sell the house, and move into one of those assisted living facilities when the time comes. And again, I don't know enough information to really build a plan on this. You might have $1 million house and $100,000. If there's $900,000 in equity, I'll tell you how to tap into that equity and double your lifestyle if you want. If you've got kids that are just dying to own your house and you don't want to encumber it, and that's just the inheritance you want to give away, and you just have no intention whatsoever of using any of that equity or using that as your fallback position, I think you're putting yourself in a pretty restricted retirement planning state. Again, if you've got a $200,000 house, you owe $100,000 on it. I'm guessing that I can probably tell that your income's probably not six-figure range. It's probably a little less than that, and you're probably going to be able to live on $4,500 a month because you've been doing that already. And the problem is what do you do for those unexpected, retirement expenses, the health issues that might not be covered, therapy after your Medicare and your supplement runs out, if you have a long-term recovery from an illness or an injury, the long-term care, even the short-term stays where you get a knee replacement and have to go into a facility for a few months. I mean, those are out-of-pocket expenses. And you need a nest egg for that. And I don't know the overall picture or how much you could save, how much you're making. There's a lot more to be desired to build a plan for you. But, I think you have a good start. At least you know what your income's going to be and you know what you owe. It seems like you probably have no other debt. And what you have to do is just build kind of a savings, retirement plan and figure out how you're going to live on that $4,500 a month.
It's generally been said that the last 5 years before your retirement date may be the most important, and it's because, things can change, whether that's your job, your family situation, or your own goals. But I think Daryl asking that question 5 years out indicates that he's on the right path. Daryl, thank you so much for listening to the program. Of course, we'll be sending you out Jeff's book, Retirement: The Road Ahead. Next question, Jeff, is from Bill in Rancho Vistoso. Bill writes, with the Fed rate cuts and more on the way, how do these rate cuts affect the different segments of the market?
Well, a rate cut just inherently will affect the bond market, meaning that if interest rates go down, the price of bonds go up. And we've already seen that. We've seen about a 10% increase in just bond prices over the last year or so, just with the anticipation of rate cuts. Now that we're getting them, we're still getting those longer term bond holdings are starting to drop in, the yields are dropping under 4% for the first time in probably a year and a half. But they're dropping down below, and we're getting some of that money back. Some of the bond portfolios, if you had a lot of bonds, the value of your bonds may have dropped 20 to 30% in 2022, and they've been stagnant and stayed down until just recently. So the last 6 months, we've got this little boost in the bond market. So just in that alone, the bond market does better in a interest rate cutting environment. Now, the Fed is only cutting short-term interest rates right now. The market is actually cutting the rates on the long-term bonds just by bidding the price up. And when the market's as strong as it is, and the Fed's still creating liquidity through various measures, even though they say there's tightening, they're really not. It's interesting that smart money is still buying up bonds. It's also interesting that they're buying up gold. Gold has gone up and set new record highs. The only reason that the world buys gold is if they think that a recessionary time is pending. That's typically when we see the best increases in gold. Sometimes it's just because of liquidity, nobody knows what else to buy. But I think this is really showing that a lot of smart money is getting out of the market, going into gold. A lot of the private household money is going into the stock market because they're getting fed this hype and this AI craze, which is a craze. Just like the .coms were a craze. I mean, there's going to be some emerge in great shape, and there's going to be a lot of money lost because people have speculated and driven up stocks that don't end up emerging out winners. And there's going to be some money lost too. And it's typically the average Joe that loses the money, not the market makers, the banks, the brokerage firms themselves. Now, as far as speaking of tech, the AI craze, tech are very heavy borrowers, and so the tech market typically really likes lowering interest rates. But again, you've seen the NASDAQ. It's gone up so much in the last year and a half or 2 years because of these hyped up Fed rate cuts that are supposed to happen, and they're finally happening. Well, they really haven't happened to the extent that so these companies save so much on interest that they can, drop that money straight to the bottom line. If they're borrowing a lot of money for whether it's R&D or just for, floating loans during productions between the time they sell something and the time they have to build it and ship it, the fact is they're floating loans. And if they're borrowing money at 5%, it certainly on billions and billions of dollars, it certainly costs them more than it would if they're borrowing at 1 or 2%. And so, if you've got $300 or $400 million in extra profit that could go straight to the bottom line every year just because of interest, then, it would make the companies, able to spend more on R&D, maybe build new facilities, or maybe just, make the stock a better value. So tech gets helped a lot by lower rate cuts, probably in a bigger way than some companies that don't borrow a lot of money. I would say Apple would be the exception. They got so much cash, I don't think they need to borrow money. They don't have to borrow money. They can, and a lot of times they do borrow money, so they don't have to use their own cash. They can invest it. But the other sector that really has been affected by the interest rates is really the mortgage business, is the people that want to buy houses that can't afford them, young people especially. Now, for old people that owns a home and they want to sell or downsize, they're loving this because they've had great, appreciation. But the younger person can't buy that home at a higher price and with higher interest because, 3-4 years ago, they could have bought a house with, a nice, let's say 3 or 4 bedroom house and had a payment of $1,500. Now they try to buy that house, the same house. It's going to cost them $4,300 a month for between the mortgage interest, the extra price of the house, bigger down payments got to come. They typically have to come up with. Not to mention the taxes have gone up, generally speaking, a little bit. But homeowners insurance has practically doubled in the statistics that I've seen. In fact, I just got a homeowner's policy myself on our cabin up in the mountains. It more than doubled since I bought the cabin only 4 years ago. You've got a lot of things that would greatly benefit by lowered interest rates, especially that housing market, building materials. Any company that borrows money is going to be benefited by lower interest rates. Here's the problem, though. Lower interest rates also create essentially more liquidity where people, especially the wealthy people that have money, can buy more stuff and drive prices up. So the people that are not able to take advantage of maybe increased investment opportunities or investment gains may not still be able to afford things because that extra liquidity will actually, and the lowering interest rate will actually make the common house, let's say it's a $600,000 house and you can borrow at 6.75%, which I think is the current interest rate level, somewhere in that range. We've got, $4,000 a month mortgage. Well, okay, so let's say the interest rates go down to 3 over the next year because they have a massive bunch of rate cuts. Okay, well now your mortgage would be $3,000 on that same house. However, the price of that $600,000 house is probably $800,000 now because, hey, people who could have bought it a year ago or 2 years ago, were willing to pay $4,000 for it. So, and part of the real estate run up that we had a couple of years ago was really because interest rates were so low that it justified everybody's buying it based on the payment they can make. They didn't really care what they were spending on a house. And man, with houses going up, everybody started building houses and started selling houses, flipping houses, doing fix-ups. Became a bigger demand for lumber and materials, so those went up. And I don't know, just this inflation thing just kind of got out of hand. Well, and then they had the COVID situation, which bottled up the supply chain. That made things go up even more. With added liquidity, people are willing to pay more. So we need to get interest rates back at a good level, but we also have to get supply. We have to get things in a position where we don't also just create a huge supply backup with extra money. Then only the rich people can buy things. It'll actually drive inflation to an unprecedented level again. If we look at stagflation years of the Jimmy Carter years, there was 3 phases where there was kind of a phase where we thought we got it under control, and each time that inflation component kept coming back stronger. We had a bigger wave of inflation. There's some people that are predicting that after they have a bunch of rate cuts, that next year we're going to have inflation. They're going to have to raise rates to the point where mortgages are going to be over 8%. I've read that from really smart people that's what they're kind of betting on. So it might be good to take advantage if rates ever get down around 5. Man, lock in that might be the lowest we see for a while until there's another couple of phases of inflation and deflation and manipulation with the interest rates happen. So I don't know. We got a big hole to dig out of. We've kind of been really careless from a fiscal standpoint in the government, but of course they're politicians. They know how to get elected. They don't know how to run countries or do economics in the real sense of economics. They pretend they do. They hire people that supposedly do, but then they just give us BS numbers to make it sound like everything's hunky dory. So you'll elect the people again. Unfortunately, it's not a real picture of what we're seeing. But the bottom line is, lower interest rates typically help the market. They will help people buy stuff. You can probably buy a car with lower interest rates if you have to finance. Maybe you can buy a little nicer car that way. That's the whole premise of lowering interest rates is if we can create a situation where more people can afford to borrow money to buy things, then that's great. But again, buying more things can create inflation too. So we've got to balance carefully. But if you're looking at the sectors in the market that I think do the best, I would say real estate and tech.
Bill, thanks so much for that question. We appreciate you listening to us. We'll send you out Jeff's book, Retirement: The Road Ahead. Jeff, next question is Larry listening to us in Oro Valley. Larry writes, how do you incorporate new cars, new roofs, travel expenses, and other big ticket items into a retirement plan?
Well, I think this is what I was worried about mostly with the Daryl's question a couple of questions ago. And that is, okay, you've got some great income, but how do you incorporate new cars, new roofs, travel expenses into a retirement plan? Well, if you have only income but no savings, then you better start a savings plan where you build a little nest eggs for those things as they happen. Obviously, a car is going to be something you do every few years. Roofs, hopefully not more than every couple of decades. Travel expense is probably something you just want to incorporate into your regular expense plan and just build it in. We do a spreadsheet, and if you want to say, okay, every 5 years I'm going to throw $40,000 at a new car, where does it come out of? Typically, we have a nest egg for those chunk expenses that happen, and that's money that we don't usually, put into annuity or take a monthly income from. We just let that grow, because as long as that grows and we still have that little buffer against surprise visits from the boogeyman that says, uh-oh, your roof's leaking, or the storm just blew out your windows and you need new stuff, or your car just blew up and you can't afford to fix it anymore because it's just costing too much and a new car would be cheaper. Those things need to come out of a place where you can just continue to grow that account. So you want to have an account that you don't touch. Maybe I wouldn't put it in super risky growth funds, but I would put it in, if you are taking it out of savings and dollar cost averaging in the market, maybe you do that. You need to just have a place you put away, kind of that 6-month or 12-month emergency fund. Or you could just say, hey, this is my car fund. I'm going to put $1,000 a month away into this car fund, and every 4 or 5 years, I'm going to have, $50,000 to $60,000 I can, spend with my trade-in to buy a new Mercedes or whatever. I don't know. Or you say, I'm only going to drive my cars for 2 or 3 years, and they're going to depreciate about 20 grand, and that's all I need to save every couple of years for a car. But it's not hard to build it in a plan. We put everything out on a spreadsheet on a year-by-year basis, and if you can kind of hold true to that plan, the plans will work. If there's surprises, we need an account to be adjustable and a little more flexible to cover those surprise things.
Larry, thanks a lot for listening to us in Oro Valley. Of course, we'll send you out Jeff's book, Retirement: The Road Ahead. One last question this week, Jeff. It is from Ellen, who's listening to us in Savannah. And Ellen says, can you explain in detail the different ways that you could gift your money to a charity while you're still alive?
Well, you can just give donations. One of my favorite ways is if you don't need your required minimum distributions from your IRAs or 401ks, you can give those directly to a charity, and they come off the top, and they are not taxable to you, nor do they come in as a 1099 to you. And so you just do a direct charitable contribution and do it directly from your 401k. You can just transfer it from your Fidelity account or from your T. Rowe Price account, whatever. Even your annuity payouts can be directly given to a charity, and they don't show up on your tax return anywhere. And then you get to take advantage of the entire standard deduction. What normally people will do is they'll take the required minimum distribution, let's say it's $20,000, they give $10,000 to a charity, and then when they do their taxes, they have no other write-offs because they don't have a mortgage, they don't have kids' tuition to pay for, anything that can write off. A single person has $14,000 or $15,000 in standard deduction, and basically you get to write off $15,000. Anyway, well, that $10,000 didn't help you at all by giving it to a charity and as a tax break. What if you were able to give it directly to a company? Then you get the $15,000, plus you don't have to pay tax on the $10,000, the charity benefits, and you save, $2,500 or $3,000 in taxes that you would have had to spend to the IRS and let them blow for you in some stupid place that you don't appreciate. Instead, you got to give all $10,000 and, kept more in your pockets for future charitable donations. And you get to direct where it goes. So that's probably my favorite way to give money to an organization. Now, if you've got millions of dollars and you want to try to pare down your estate and do kind of some sort of an estate freezing because you've got a big estate tax program, you can do what's called charitable remainder trust, where you put your assets in a charity, you live off the income, and when you die, it just passes on. But you still have relatively good control of that asset, or at least the income. You can do what's called a charitable lead trust, where you give the money, or you just give the interest, and then the balance is forgiven as a tax write-off when you die. You can give a chunk in a charitable remainder trust where you get to use the income. You basically invest it with the charity, and then they give you income on it, and the remainder of it goes to them. And the nice part is you get an upfront charitable deduction that you can actually use now against the other income and carry it forward for a number of years. So depending on how you set it up, you could end up giving away a pretty large estate without paying estate taxes. You can even do a charitable remainder trust that is generations deep, where you can give kids and grandkids 30 or 40 years of income from an asset and only leave 10% to the charity if you want to be not stingy to the charity. They're going to be getting interest and money over the next 30 or 40 years, just like your kids are. But you can still get a tax break by spreading out even IRA money. The IRS says you have to, if your kids inherit a huge IRA, they've got to pay taxes on it in the next 10 years. Well, what if you did it through a charitable remainder trust? It's tax-free to the charity, and then the charity can pay you and your kids for a longer period of time than 10 years. So there's a few different tricks. Those are just some off the top of my head that came to mind. But depending on your situation and how big or small the plan is, or how bad your situation is with taxes, you might want to be a little bit more aggressive with tax planning.
Edlin, thanks a lot for that question. And of course, you'll get Jeff's book, Retirement: The Road Ahead. Listening to the program today, we haven't answered your question. We would love to do that on the air for you. You can get it to us two ways, one of which is to call Shelley. 520-780-9059 is the number to use, 520-780-9059. You could also go out to the website, premret.com, premret.com. Use the contact page, and you can put it in there. And, of course, we'll send you out Jeff's book, Retirement: The Road Ahead, if we use it on the air. You're listening to Premier Retirement with Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Once again, our telephone number, 520-780-9059. Use that number today. Call and leave your name, telephone number if you would like an opportunity to sit down with Jeff and have a one-on-one conversation, just a casual conversation, to ask the questions that you need the answers to put you on a path towards a prosperous retirement. Again, no cost, no obligation for this whatsoever. So take advantage of the opportunity. Do that right now, 520-780-9059. Jeff, we talk about calling that number every week, but I'm sure that still people are wondering, well, if I call the number, come in and sit down with Jeff, what is that meeting going to be like?
Well, it's really just what we call a discovery meeting where we just discover each other. I mean, you decide if I'm your guy, I decide if you're, the right type of fit to work with us. Some people call it a fit meeting, a discovery meeting, a fact-finding meeting, whatever. It's just really a get-to-know-you meeting. It's an introduction. I don't even know if I'm going to have a second appointment with you, and you don't know if you're going to want a second appointment with me until we spend an hour or so together, probably. And so that's really just, how can we help you? And you tell me, what you're up to. I'm going to tell you a few things like, when we get this all, if you want to do business here, I don't want to be stressing out about your money, so I hope you don't want to be either. And that's kind of our approach we take. I'm too old to stress out. Shoot, I was starting to get high blood pressure. I don't anymore because I don't stress out about everybody's money.
Right.
We have a structure to where you're not going to lose enough to put you out of business, and we're not going to risk enough to make you scared every morning and have to run to the stock market and see what's doing in order to see if you're still okay or not. So bottom line is, we got to get to know you, see if our goals align, see if we, make sense to each other. I know people have listened to the radio show for a year or two sometimes, or more, several years, and they finally get to retirement and say, I already know Jeff. I already know we're going to be a fit. And that's fine. But I still need to know if, your situation is such where we can make a difference. If you come in and you're in good shape and I can't make a difference for you, I'd rather spend my time on somebody that, we can help more. I'm not just a numbers guy, and I can't say, gosh, every client that comes in here, I got to close business. I got to get a new client. I don't need new clients. I don't want new clients unless I can help the new client. I want to, if I come to work, I want to be able to make a difference in somebody's life and put them, in a better place than when I meet them. And if I think I can, we'll invite you back for a second meeting where we'll draft up a first version of a plan to where this is how my successful, happy clients do it. Do you like it? Do you like this approach that we take? Do you like tax planning? Do you like being in the lowest tax bracket possible? Do you like paying a little extra taxes now so you don't have to pay taxes for the rest of your life in the future when they'll probably be more likely to raise rates rather than lower them? How much tax-free income do you want? How much do you want to leave as a legacy? Are you planning on using any of the equity in your home to live on, or is that just your little, ace in the hole nest egg for the future if you run out of money? What are your goals? What is your realistic spending plan? What can you live on? What are you living on now? Where is your money? Are you worried about some of it? Does any of it give you gut aches when you wake up in the morning and look at what's happening in the market, or when you get your monthly statements? Is it causing you stress or not? And if it is, then maybe you need to take a change. If it isn't causing you stress, then maybe if it's making good returns, it doesn't cause you stress and it makes sense, then, we'll leave some of that stuff intact. But we go through a second visit. I kind of call it fire hose visit because I dump out a lot on you, show you basically the next 30 years of your life as far as, what a good income plan and a realistic expectation of income would be with realistic conservative returns. Because I don't think we can expect 20 and 30% per year annualized returns by putting your money in the market. I mean, absolutely not. We're going to have some years where we lose 20 and 30 or even 50 like we did in 2000 and 2008. So, we don't want to be, all at risk, but we want to manage risk appropriately. We want to, talk about those things. And if you like the plan, we'll tweak it a little bit. And then usually you go home with the plan, and then we have a third visit and say, come back with all your questions. Make sure you feel comfortable. And if you get comfortable on, the third or fourth visit or however many visits it takes, as long as we're making progress in visits, we'll keep having visits. And as soon as you get comfortable, then we move forward. If you don't get comfortable at any point, we shake hands and we remain friends, and you go the direction that feels more right for you. So again, I I'm at a place where I do this because I enjoy it and I don't want to stress out about it. And the last thing I want to do is add stress to somebody who comes into my office.
Well, Jeff, based on our conversation today, I'm sure that the listeners may have some questions. If you are one of those people who would like to sit down with Jeff and have Jeff help you understand what your retirement could look like for 30 years or more, take advantage of the opportunity that we're offering right now to have this retirement roadmap. Call 520-780-9059. Ask for your roadmap with Jeff. It'll take you about 60 seconds to leave your name and telephone number. Shelley will call you back during the week and make that appointment for you. And this could be the most important call that you'll make all year. 520-780-9059. You can also find out more about us online at premret.com, premret.com. Hey, Jeff, we're out of time for this week. Thanks so much for your time. But most importantly, once again, I want to thank our fine listeners for joining us here in the greater Tucson area. So for Jeff Bogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.